First, let's take a look at how the markets performed this week. First to European markets as at Friday, January the 20th. Euro Stoxx 600 closed on 451.76. It was up by 0.29%. London FTSE closed at an all-share index of 7,766.27, up by 0.24%. The markets in Germany saw the DAX close at 15,002.37, also up by 0.54%, while the CAC 40 in Paris ended the week at 6,986.2, gaining 0.49%. And finally, the IBEX 35 in Spain ended at 8,899.9, gaining also by 1.21%. To the Nigerian stock markets now. At the end of the last weekday of trading on the NSE, a total of 443.752 million shares in more than 3,000 deals, corresponding to a market value of 1.6 billion, were traded. Compared with the previous NGX trading day, yesterday's data shows 244% improvement in volume, a 7% decline in turnover, and a 3% decline in deals. The current market capitalization of the NSE is 28.64 trillion naira. And finally, a look at Wall Street as at Friday. Now for some top business stories that made headlines this week. The International Monetary Fund, in a new report on Sunday, spelled more trouble for the global economy owing to widening trade fragmentation between industries and regions, and the IMF warned that it could cost the global economy up to 7% of GDP. The report cites several reasons for the disconnection, including Russia's war in Ukraine and the COVID-19 pandemic, which have caused international disruption to financial, food, and energy supplies, with additional trading restrictions adding to the discord between regions. Although the report doesn't state how long the fragmentation could take to impact growth of this magnitude, some forecasts estimate that countries could lose up to 12% of GDP due to technological disconnect between regions. At the just concluded World Economic Forum at Davos, President of the European Central Bank, Christine Lagarde, warned financial markets to expect further rises in interest rates to bring inflation down. Investors have been put on notice that central bankers on both sides of the Atlantic will, she says, stay the course on interest rate increases to cool down their economies and tame high inflation. Lagarde warned that further big rate rises lay ahead in comments later echoed by a top official at the US Fed. We shall stay the course until we can return inflation to 2% in a timely manner, the ECB president said in a panel discussion during the World Economic Forum. Lyle Brainard, the vice chair of the Fed, signaled that the US central bank also had more to do to get inflation closer to its 2% target, despite signs that consumer spending is starting to ebb. Analysts expect big US tech firms to continue to chip away at their bloated workforce and ensuing costs through the next few months in a bid to reverse pandemic-era excesses. They expect the Big Five, Apple, Google, Amazon, Meta, and Microsoft to report a fall in profits for the October to November 2022 period as they try to recalibrate in a high-interest environment. According to FactSet data, big tech companies are expected to be among the biggest drags to S&P 500's 11 sectors, with the tech sector projected to report a 9.5% decline in earnings. To shore up stock prices, analysts said these companies could pour money into buybacks this year. Their shares fell between 26% and over 60% last year versus the broader market's nearly 20% decline. They together have cash and cash equivalents of over $110 billion, with Amazon having the most and Meta having the least at the end of September. Well, still on tech, Microsoft says it will lay off 10,000 employees in the coming months as the economic downturn continues to punish US tech giants. The job cuts will affect slightly less than 5% of employees and follow in the wake of similar moves by Facebook owner Meta, Amazon, and Twitter, which have announced thousands of layoffs in the once unassailable tech sector. The cuts were in response to macroeconomic conditions and changing customer priorities, the maker of the Windows operating system said in a US regulatory filing. According to CNBC and TrueUp's tech layoff tracker, big tech companies have laid off around 60,000 workers within the past year, while the industry overall has seen nearly 300,000 layoffs since 2022. Now to France. Following the announcement of the government's pension reform plan to raise France's retirement age by 2 years to 64 years last week, French workers went on strike, joining marches across the country on Thursday and halting trains and cutting electricity production in a nationwide day of protest. The move, though highly unpopular, is vital to ensure the system does not go awry, according to President Macron. In favor of the reform plans, the Labour Ministry estimates that pushing back the retirement age by 2 years and extending the pay-in period would bring in a net total of 17.7 billion euros in annual pension contributions, allowing the system to break even by 2027. The unions, however, argue that there are other ways to ensure the viability of the pension system, such as taxing the super-rich or increasing employers' contributions or those of well-off pensioners. UK and European Union negotiators are nearing the end of their long-running dispute over post-Brexit trading arrangements in Northern Ireland. After reaching an agreement last week on real-time true data, the two sides are also closing in on a customs agreement aimed at reducing frictions between Great Britain and Northern Ireland since the UK left the bloc. Irish Member of European Parliament Barry Andrews told Times Radio on Sunday that there's been a build-up of trust between the parties, and the expectation is that there will be a political declaration and framework for the way forward. Newswires had previously reported that the two sides aim to unlock a comprehensive deal by the end of February ahead of the April anniversary of the 1998 Belfast Peace Agreement. In another hit to the NHS, thousands of nurses in Britain have staged a walkout in a new strike over pay, and there seems to be no end in sight to a wave of industrial action that has piled pressure on the UK's overburdened public health system. Two 12-hour nursing strikes on Wednesday and Thursday affected about a quarter of hospitals and clinics in England. While emergency care and cancer treatment continued, thousands of appointments and procedures were postponed. With inflation in the UK hitting a 41-year high of 11.1% in October and easing slightly to 10.5% in December, the Nurses Union has been seeking a pay rise of 5% above inflation, though it said it will accept a lower offer. With more planned workouts for next month by nurses and ambulance workers, announcing a new slate of February strikes, the Conservative government is under growing pressure to lift its opposition to substantial rises for healthcare staff. In response, the British government argues that double-digit public sector pay increases will drive inflation even higher and may mean cutting patient care. The European Commission is preparing a law to ensure that its green industry is well tended to assist state aid and the European Sovereignty Fund. The goal is to keep firms from moving overseas, where in the US there is a $369 billion scheme to subsidize green production. Portugal's Finance Minister Fernando Medina stated that the idea is steering in the right direction because Europe cannot run the risk of deindustrialization or losing to the US in this process. He further urged the EU on Tuesday to ensure that the stimulus package for green tech investments using financing instruments that guarantee equality should be extended to all members. Now to Asia. Japan's export growth hit a snag in December as shipments bound for China fell for the first time in 7 months, stoking fears of further slowdowns in the global economy and external demand for Japanese shipments. Economic activity has been hindered in China by a wave of COVID-19 infections after the government began dismantling its zero-COVID controls in December. Data for the Ministry of Finance shows that exports rose 11.5% year-on-year in December after a 20% gain in November. Exports to China fell 6.2% from a year ago and were down by 24% in volume. For the whole of 2022, Japan logged a trade deficit of 19.97 trillion yen, the second straight annual shortfall and the biggest since 1979. Now, China has entered an era of negative population growth after figures revealed a historic drop in the number of people for the first time since 1961, and possibly making India the world's most populous nation. This historic turn is expected to mark the start of a long period of decline in citizen numbers with profound implications for both China's economy and the world. China's National Bureau of Statistics reported a drop of about 850,000 people for a population of 1.4 billion in 2022. In the long term, UN experts forecast China's population will shrink by 109 million by 2050, which is more than triple the decline of their previous forecast in 2019. Bleak forecasts on China's demographic and economic outlook have led analysts to predict that the government will have to adjust its social, economic, defense, and foreign policies. Now, still in China, troubles are mounting for property developer China Evergrande, who reported on Monday that its auditor, PricewaterhouseCoopers, had resigned amid disagreements over matters relating to its audits of 2021. Once China's top-selling developer, Evergrande is now at the center of the country's property crisis. Its $22.7 billion of offshore debt, including loans and private bonds, is deemed to be in default after it missed payments late last year. Evergrande was suspended from trading in March 2022 and could be facing a delisting if stock exchange requirements are not met. It has been scrambling to raise funds to repay its creditors in the midst of a debt restructuring process in which stakeholders are awaiting the completion of its audited financial accounts for 2021. PwC joins more than a dozen auditors of Hong Kong-listed Chinese property firms to part ways. In Africa, Congo DRC's finance minister, Nicolas Kazadi, told Reuters in an interview that the country is expected to reach an agreement on overhauling $6 billion of an infrastructure for minerals deal with Chinese investors this year. Speaking from the World Economic Forum in Davos, Kazadi said the government is in active talks with representatives of Siccar Mines, a cobalt and copper joint venture with Chinese state-owned firms, as well as China's CMOC Group's copper and cobalt mine, Tenke Fungurume. The president has been revisiting a 2007 deal struck by his predecessor, Joseph Kabila, under which Sino Hydro Corp and China Railway Group Limited agreed to build roads and hospitals in exchange for a 68% stake in the Siccar Mines venture, as well as a 2008 contract with CMOC. Back home in Nigeria, inflation dropped to 21.34% in December 2022, down from 21.47% the previous month, as published by the National Bureau of Statistics in its monthly report of the CPI data, which measures inflation. It added that on a year-on-year basis, the headline inflation rate was 5.72 percentage points higher compared to the rate recorded in December 2021, which was 15.63%. According to the report, the likely factors responsible for the increase in the inflation rate month on month can be attributed to the sharp increase in demand usually experienced during the festive season and increases in the cost of production, such as energy costs, transportation costs, and exchange rate depreciation. Now, finally, Nigeria is refusing to join an overhaul of the global taxation system it says is skewed to the interests of rich nations and could hurt the country's tax revenue. That's according to Finance Minister Zainab Ahmed. The negotiations were not conducted on an equal footing, favored wealthy economies, and created rules that are too complex for Nigeria to effectively implement, she told a panel at the World Economic Forum in Davos. If we sign up to this, it means we're excluded from getting taxes from medium-sized companies that we now actually, by our own laws, have an opportunity to collect taxes from, she said on Thursday. Nigeria's continued holding back has raised questions about the OECD-led initiative, which aims to set a minimum corporate tax rate at 15% and share out rights to tax the world's biggest firms more fairly. One report released Wednesday by the Paris-based organization showed that governments around the world could gain around $250 billion a year in extra revenue by enacting the two-part deal. And that's it for the market roundup and top business stories this week.